What is a stimulus check? What is monetary policy? How does it work? On March 26, 2020, the United States Senate passed a $2 trillion stimulus package in response to the COVID-19 pandemic with President Donald Trump's support. President Joe Biden is working on another $2 trillion stimulus package as of early January 2021. So where is the money coming from and how does it help economy? In economics, stimulus refers to attempts to use monetary or fiscal policy to stimulate the economy. Stimulus can also refer to monetary policies like lowering interest rates and quantitative easing. Often, the underlying assumption is that, due to a recession, production and employment are far below their sustainable potential due to lack of demand. It is hoped that this will be corrected by increasing demand and that any adverse side effects from stimulus will be mild. A stimulus is sometimes colloquially referred to as priming the pump or pump priming. Used in economics, it is often argued that fiscal stimulus typically increases inflation, and hence must be counteracted by a typical central bank. Hence only monetary stimulus could work. Counter-arguments say that if the output gap is high enough, the risk of inflation is low, or that in depressions inflation is too low but central banks are not able to achieve the required inflation rate without fiscal stimulus by the government. Milton Friedman argued that the Great Depression was caused by the fact that the Federal Reserve did not counteract the sudden reduction of money stock and velocity. Ben Bernanke argued, instead, that the problem was lack of credit, not lack of money, and hence, during the Great Recession, the Federal Reserve led by Bernanke provided additional credit, not additional liquidity, to stimulate the economy back on course. What is monetary policy? Monetary policy is the policy adopted by the monetary authority of a nation to control either the interest rate payable for very short-term borrowing or the money supply, often as an attempt to reduce inflation or the interest rate, to ensure price stability and general trust of the value and stability of the nation's currency. Monetary policy is a modification of the supply of money, i.e. printing more money, or decreasing the money supply by changing interest rates or removing excess reserves. This is in contrast to fiscal policy, which relies on taxation, government spending, and government borrowing as methods for a government to manage business cycle phenomena such as recessions. #stimulus check. Economics. What is a stimulus check? What is monetary policy? How does it work?